Sherwin-Williams just beat Q2 2026 consensus across the board.
Yeah, they really did. I mean, adjusted EPS came in at $3.70, which easily beat the $3.52 estimate, and revenue hit $6.79 billion.
Right, coming in nicely ahead of that $6.60 billion forecast. And they raised guidance too, didn't they?
They did, yeah. Full-year adjusted EPS guidance is now up to a range of $11.80 to $12.20.
And the stock reaction was just immediate. I mean, it jumped over 7.5% in pre-market trading, basically pushing right up against its 52-week high.
It is a massive move, but the real puzzle here is that, the housing market is totally stalled out right now. DIY projects are just kind of collecting dust.
Right, which makes this so fascinating. So today we are taking a deep dive into the Q2 earnings reports, a bunch of analyst notes, and the management transcripts to see exactly how Sherwin-Williams is pulling this off.
Yeah.
Because there's no broad economic tailwind here at all.
Exactly. I mean, they are basically painting a masterpiece in a terrible macro environment, and it really comes down to just pure execution. Like, if you look at their biggest division, the paint stores group, sales grew 5.1%.
And same-store sales were up 4.2% in there as well, right?
Yeah, driven heavily by their protective and marine division, which jumped by mid-teens, because they aren't just selling residential house paint. They are capitalizing on these massive infrastructure projects, like data centers and semiconductor fabs.
Oh, wow. Yeah, that makes a lot of sense. And then you have consumer brands, which surged, 21.5%?
Right, a huge jump on paper.
But wait, 21.5% sounds incredible, but isn't that mostly just the Suvinil acquisition in Latin America kind of masking weak underlying demand? I mean, it feels a bit like claiming your house remodel was a huge success just because you bought the house next door and added its square footage to yours.
That is a completely fair point, and Suvinil definitely padded the top line there. But the true drivers of this overall earnings beat were actually organic market share gains in the pro segment. That and just serious pricing power.
So they are actively taking share away from competitors.
Yeah, actively taking it in areas like residential repaint and commercial property maintenance, and they do this by leveraging their massive pro-focused store network. I mean, contractors know Sherwin-Williams will literally always have the materials they need.
Right, even when the smaller competitors are facing, supply chain hiccups and stuff.
Precisely. So it is a huge availability and scale advantage. And to your point about the acquisition, if you actually exclude the Suvinil deal, their core business margins actually expanded.
Oh, really? So Suvinil was actually dragging the average down?
Yeah, it had lower margins, so it was dilutive. The core organic business is incredibly strong.
Okay, well, if organic share gains and scale are doing all that heavy lifting, how is management positioning for the second half of the year? Because they just announced this pretty aggressive 8% price increase taking effect September 1st.
Yeah, that price hike is the absolute pivotal move to watch right now. If you read into CEO Heidi Petz's commentary, management is being incredibly blunt with the market.
Blunt how? Like about the macro environment?
Exactly. They explicitly stated there is no broad demand recovery in sight, especially for DIY or new residential construction. So instead of waiting for the market to hand them a win, their strategy is just forcing growth by taking share.
But pushing an 8% price hike onto customers in a soft market, I mean, that has to carry some serious risk, right?
Oh, it definitely does. But they are kind of forced to do it because raw material inflation, driven by oil and related cost pressures, is expected to accelerate into the mid-single digits in the second half.
Right, so the risk is whether customers actually push back on that 8% hike.
Yeah, historically, they managed to retain about 60% to 70% of a price increase. But if they can't achieve that this time because the market is just too weak, well, those rising raw material costs will absolutely squeeze their margins tight.
That potential margin pressure really makes you wonder about their broader cash strategy, too. I mean, despite generating all this incredible cash flow, management recently walked away from a massive joint bid to acquire AkzoNobel.
Right, they basically refused to overpay. Instead of forcing some mega merger just to buy growth, they took $1.5 billion and returned it directly to shareholders this quarter.
Through buybacks and dividends, yeah. So here's a thought for you to mull over as you evaluate this stock. Does this disciplined capital allocation prove that Sherwin-Williams doesn't actually need major M&A to justify its premium valuation?
It's a great question. They clearly know exactly how to keep their foundation solid while the rest of the neighborhood is struggling.
Absolutely. Well, thanks for joining us on this deep dive. Make sure to hit follow for your daily earnings coverage so we can keep analyzing your stack of sources and keep you a step ahead of the market.